Well, good morning and welcome to the March 2024 Spears & Associates Drilling and Production Outlook Workshop. This is an update to our earlier work. The most recent one was back in December of 2023, so 3 months ago. But again, what we'll be doing for the next 60 minutes is looking at the issues that are driving the capital spending decisions in the upstream sector of the oil and gas business, and trying then to make sense of what that might mean in terms of measurements of activity like rig count, wells drilled, dollars spent, and so forth. I'm John Spears. I'll be your host for the next hour. And what I'll be doing is running through a slide deck that hits the highlights of the forecast that we've prepared. And then at the end, we'll be answering some questions. We'll come back after that slide deck's over and answer some questions. In the meantime, the material you're being sent, or you'll be seeing, has been sent out to our subscribers. Please let us know if there's anyone in your shop that needs to be receiving this information. We're happy to send it to them directly. So you just need to let myself or anyone around here to how we might be able to update our subscriber list. I should say that any questions you have, please feel free to submit them as we're going along, either in the chat box or online. We'll be answering them in those places as we go along, and then anything left over and other ones that have already come in, we'll be answering after I'm done with the slide deck. We'll be getting to it. Let's cut to the presentation and we'll start it going. Great. Well, like I said, months have passed since we last updated our forecast, and we've wrapped up 2023. So for those of us who follow the upstream sector closely, rig count in the U.S. ended up down 4% for the year in 2023. Canada was up 2%. The international rig count numbers outside of North America were up 11%. So that left, industry-wide anyway, rig count up about 4% for the year. Then heading into 2024, on the back of expectations that oil prices would be in the $70 to $80 range, gas prices would behave themselves and so forth. And so, since our December work, obviously several things have come to pass that give us a little bit more information and reason to update our forecast. Near-term items, of course, are the El Nino winter that we're experiencing here in North America and what that's been doing to gas demand and gas prices. There's always changes or moves afoot with regard to OPEC plus production policies and quotas and so forth. And so a little bit more information as to what the near term for those and for that body will be. Then there's always, what's the outlook for economic activity in the US, in Europe, and around the world. So those are, broadly speaking, the items that I think we want to talk about that will have an impact, we think, in our near term in 2024 activity measures. There's always longer term issues that I think we'll touch on as well in the course of this morning. That's the nature of sort of what is happening with regard to announced field development plans, any regulations that affect demand and supply for oil and gas, and so forth. So something happening in both those areas, and so let's go ahead and get right to it. We always like to start, it's pretty easy to focus on what's happening in the global oil market with regard to supply and demand. And so here's our first slide looking at just those two things. I've got on the left-hand side a look at change in oil demand last year and 2024 and 2025. And as you can see, just sort of broadly speaking, it appears the expectation is that global oil consumption, the growth, year-over-year growth, is slowing down. It ended up on just shy of 1.5 million barrels a day of growth in ended up about 1.8 million barrels a day in 2023. It looks like it'll be 1.4 million barrels a day this year, and the most recent expectation is that for next year we'll see about 1.3 million barrel a day growth. So the shading of the bars kind of tells us where the growth is happening, of course. As you can see there, China, which is in red, was a significant part of global oil demand growth in 2023, but was much diminished, will be much diminished in 2024 and in 2025. You really don't see anything that's either in black, which would be the US, or gray, which is in Europe, for any of those 3 years. So we're really not seeing much in the way of increased oil consumption in those two markets at any point over this 3-year time frame. And what we're really left with then is oil consumption growth looking pretty steady from what's called other Asia. So that's the part of the Asia Pacific market excluding Japan and excluding China. So other Asia, which is the light yellow there, and then in blue we have just other, the rest of the world in aggregate. And what you really see when you sort of stare at the chart long enough is that other Asia and the rest of the world, the yellow and the blue sections, each of these 3 years is about 1 million barrels a day of oil consumption growth. Been very steady. Everything else has either shrunk to almost nothing, like in the US or Europe, or has fallen sharply, as in the case in Canada. But the rest of the world, other Asia and the rest of the world, continue to stay fairly steady. So something to keep in mind. I try to remember anyway, because of course the headlines are dominated by what's the outlook for the U.S. economy and oil consumption here and in China. And really what we see when we look at the overall numbers is that it's really these other two areas that are accounting for 75 to 80% or more of the growth in oil consumption. And we just don't hear much about it. It's hard to characterize those and get timely information on that. So I can understand why the news flow isn't as strong in those other areas, but it's something to keep in mind that that's really where the action is these days. The other part on this page, of course, is the look at the change in oil supply and the numbers we see there. So both charts are scaled the same way. So they range from a low of negative 1 million barrels a day to a plus 3 million barrels a day for both oil and on the demand side and on the supply side. So, but of course, what's happening on the supply side is that some producing areas actually saw production fall back in 2023, and we'll see it decline again in 2024. And so it's a little bit trickier to get a handle on what the net number is, but basically net oil supply grew by about 1.6 million barrels a day. Last year, it's on track to grow about 0.6 million barrels a day this year, and up about 1.5 million barrels a day next year, all these supply numbers. So again, you look at demand and you look at the supply thing, and you say, well, demand in supply exceeded, or certainly came close to matching demand growth last year. But in 2024, demand will be growing faster than supply as OPEC is taking barrels off the market and trying to defend prices. And then come next year, it looks as if supply may grow a little faster than demand as OPEC sort of begins to restore some of its lost barrels to the marketplace. But again, it's instructive to see these charts broken out by region to understand where's the net growth coming from. So 2024, I think, is particularly informative because, again, what you have happening this year is that both OPEC and Russia together will be reducing their output. And we'll see about 250,000 barrels a day growth in terms of U.S. oil production. And then we see little bits here and there from a lot of different places. We've got Guyana, we've got Brazil, we have Canada, all adding to their output in the course of 2024. So many of those places will also see continued output growth come 2025. So there's at least over the near term anyway, we're seeing a fair amount of production coming in the market that's outside of OPEC and outside of the U.S., which have been the two big areas that, again, you hear the most about. I must say that in this, in the 2025 numbers, the part in black in this chart, which is the estimate of our U.S. Production growth, are really our own numbers. So they add up to about 250,000 barrels a day come 2025, net incremental growth in U.S. oil output. Right at this moment anyway, the EIA is forecasting that the U.S. will see its oil production grow by something like 650,000 barrels a day come next year. And I just don't see how that's happening, given what I think I understand about what operators are doing to sustain production, not grow production, focusing on profitability and so forth. So I think at the moment, the EIA has kind of overestimated what it might see in terms of a supply response from the U.S. market, at least with regard to 2025. So I should say too that we expect in our forecast that OPEC Plus in its upcoming meeting here in March will choose to roll over its production cuts. So the regime that it's operating under right now is really just for Q1 of 2024. We think that the agreement will be extended for another quarter and be in effect for the whole first half of 2024. And then in the back half of the year, I wouldn't be surprised if we began to see OPEC add some barrels back into the marketplace if oil prices have tracked higher, as we expect they will. So that's our story briefly on the oil side. Natural gas markets here in the U.S., I think, demand some attention. And again, here's what we think is happening with regard to demand, our chart on the left-hand side, and production, our chart on the right-hand side. Demand here in the U.S., I think, is always useful to think of in terms of what's happening in terms of domestic consumption. So that's the red part of the bar. And then the export story, which is the black part of the bar. Domestic demand growth has been almost perfectly flat for the last several years, and we don't expect to see much of change in that come 2024 or 2025. Really, all the incremental growth from a demand standpoint here in the U.S. we think is going to accrue to the export markets, where we're sending gas by pipeline across the border to either Mexico or Canada, or by ship to all points on the compass, I guess. And so consumption numbers we think might rise 2% this year, but that is questionable because of the weather effects that always seem to change from year to year. Exports we think will be up about 3% this year. We saw big growth in LNG exports last year. There'll be some growth in LNG exports, we think, again in 2024. And then, of course, gas production, which in 2024 is expected to exceed about 104 BCF a day. So up not quite 1% come 2024, so a little bit of growth there. But again, the gas production numbers are climbing a little bit. And so from a supply and demand standpoint, it would appear that the gas markets are in fairly decent shape, but we know that's not the case. Gas prices, as we'll soon see, have been weak since just about the day we hung up the phone from our last meeting, thanks to El Nino. Much warmer winter than normal, and while there have been individual weeks that have seen a lot of consumption right now, I think we're looking at gas inventories that are about 12% higher than they were last year, and last year was a warm winter in and of itself. So we're even above last year's numbers from where we stand in terms of inventories. I think we're almost 20% higher than the 5-year average for inventories at this point of the year. So that surplus of gas in inventories has really weighed on natural gas prices, and will take us, as we all are well aware, most of the rest of the year in order to work off and sort of restore a normal condition to the marketplace. But the other thing I think it's worth being aware of, and something that we really haven't spoken to directly in previous webinars like this, is what's happening in terms of LNG exports in North America as a whole. So we've always talked about the U.S. market and the growth in LNG export capacity, but we're also seeing that happening as we sit here today, even in Canada. So that's the red portion of the bar you see on the chart on the screen. And then even in Mexico is planning to begin exporting LNG toward the end of this decade. And so that's the black portion of the bar. And so in aggregate then, we're looking at a pretty substantial growth from where we stand today. So in the U.S. Market, which is where we are in 2024, there's about maybe close to 13 BCF a day of export capacity. By the time we get to the end of the decade, the North American number will be roughly double from what it is today. Much of the growth happening in the U.S., but Canada and Mexico as well. Now, this, I think, paints a hopeful story for Canada because most of the gas that they would like to export by LNG will be coming from Canadian fields. What's interesting in the case of Mexico is that these Mexican LNG exports will be supplied by pipelines crossing the border from Texas. So that's really adds to the upstream story of the U.S. market, I think, with regard to these LNG volumes that might materialize from Mexican export terminals. But again, it'll be an interesting market to go into because you may be aware that in the past week or two, Shell and a couple of others even have come out with estimates of growth in the global LNG market over the next several years. Shell's numbers suggest to them that global LNG demand will be up 50% between last year, when it totaled around 400 million tons, if I remember correctly, and 2040, when it'll be somewhere over 600 million tons, according to their lights. So a tremendous increase in the global gas market, or global LNG trade, I should be specific to that point. What's interesting is that when you think about where the supply side will come from, let's say the incremental growth is around 200 million tons of LNG. That will, about a third of that will come from US and Canadian sources, and about a third of it will come from Qatar, and then the other third will come from a variety of other places around the globe. So, but North America and Qatar will be poised anyway to be the two biggest suppliers if the LNG market grows as Shell expects it to. One of the things I think we all have to be alert to, though, is the fact that in the European Union, gas use is down on the order of about 20% over the last 2 years. Obviously, a lot of that had to do with their desire to free themselves from dependency on Russian pipeline imports. And so while their use of LNG has increased, their total use of gas has fallen, and the EU is intent on preventing their use of gas to recover going forward. They want to continue to trend lower in terms of natural gas use. And this is a pretty big thing because European Union is about a third of the global market for gas, for LNG at this point. So where they go will help set the expectations for global LNG. Much of what Shell is talking about in terms of net growth in the market is really looking toward China and Asia Pacific as the real driver of LNG trade over the next decade and a half. But Europe will have certainly a say-so, since it's such a large part of that market today, and so its actions will set the tone for the market going forward. I must say too that these numbers that you're looking at here in terms of our export capacity here in the U.S., the pause that the Biden administration has announced recently don't really affect these numbers, because there are 5 facilities that are currently under construction, and those have been permitted and approved, and so they'll enter the market as planned and over the next sort of 5 years or so. So it's really only in the last couple of years in this forecast period does the pause on new permits might affect what U.S. LNG export capacity could reach. So with all that said, what do we think will happen in terms of both oil and gas prices? Well, spot WTI prices, we think on average this year will come in around $77 a barrel. Last year, they averaged just under $78 a barrel. So we don't see a lot of change in terms of the year-over-year numbers for WTI. A bit of an increase next year if we're correct in the market tightening as we go along. But still quite a large trading range could be expected. So we have said in the past, and we're sticking with our guns, that WTI could trade anywhere in a $70 to $90 range during the course of this year and end up averaging around $77 a barrel. Our assumption on the Brent side is that Brent will trade about $5 a barrel higher than WTI. So a $77 price for WTI means an $82 price for Brent on average for the year, and maybe an $84 price for Brent at the very end of the year. So our WTI price gets closer to $79 by the end of the year if we're tightening as we think it might, and Brent at $84 at the end of this year, and then ticking a little bit higher come 2025. On the right, we look at the disaster that's been the Henry Hub spot price. It traded almost $6.50 a barrel back in 2022 when the European demand for LNG went through the roof. Last year's warm winter brought gas prices down to around $2.50 per million BTU. This year, it now looks like we'll end up averaging somewhere around $2.25 for natural gas, the Henry Hub price in 2024. And then if we're correct in terms of inventories beginning to straighten themselves out, then hopefully we'll see a bit of an increase in terms of gas prices come next year. But like I said, the warmer than normal winter has left inventories much above where they even were a year ago, and contributed to the downturn in prices that we've seen. And these are just prices for the year as a whole. I mean, we all know that today we're trading around $1.50 or thereabouts, $1.60 in a lot of markets around the U.S. I think the Waha price has been below $1 for several weeks now. The Marcellus price hasn't been much higher. So clearly, every region of the country, at the moment anyway, if you're a gas producer, you're in the red, below your break-even price for gas. Over the course of a year, as we begin to recover, then like the Marcellus, which we think has a break-even price somewhere around $2.50 for gas, that should begin to return to the black as the year goes by. But a lot of other regions, I don't know of any other region that will be back in the black before the end of this year. And so in the drilling forecast, as we see it, there'll be some weakness in gas-related activity and gas-centric marketplaces, just because of the poor economics for gas drilling and production at the moment. So, now, what does this mean just in aggregate? So, just at a high level in terms of all the rigs around the world. So that's our chart on the left-hand side. We're looking at global rig count. Blue is the US, red is in Canada, black is the international piece. Our history here ties to the Baker Hughes rig count. So that's the number we're effectively trying to forecast in this exercise today and in the material we put out. So again, last year saw aggregate rig count up only about 1% or so. It was up. It was down 4% in the U.S., up 2% in Canada, up 11% internationally. All this in 2023. The aggregate numbers were up about 4% in 2023, leaving us just shy of 1,700 rigs for the year or 1,750 rigs for the year as a whole last year. In aggregate, we'll be down about 1% this year, and then up about 3% in 2025. So we'll get into the specific regional forecasts in just a moment, but that's what we think will be the big picture in terms of rig activity. The slide on the right-hand side is our look at what we think will be total spending for equipment and services in the upstream sector of the oil patch. So we have a separate publication called the Oilfield Market Report, and that report tracks spending in 32 categories on a global basis. So we've got artificial lift on one end and well servicing on the other end. We don't quite go A to Z, but we go A to W anyway. And so those 32 segments last year saw a combined right at $300 billion being spent on a global basis for those goods and services, we estimate. We think the number will be up about 7% this year to around $320 billion, which is then kind of a disconnect because on the left-hand side, we're talking about rig count falling about 1% in aggregate, but spending going up about 7% in aggregate come 2024. And the reason is really linked to the spending on the international and the offshore sector. So, for example, we estimate that come 2024, that spending for offshore contract drilling on a global basis will be somewhere around $30.5 billion, up on the order of about 14% year over year. Another offshore segment, a big offshore segment, is offshore construction. That's another one which we think will be total spending just shy of $28 billion in 2024, but up about 10% from where it was a year ago. And then the third big offshore category is what we call subsea equipment. And that's a category that we think will see total spending on the order of $16.5 billion in 2024, up about 9% from what it was last year. So collectively, these three offshore-centric markets account for about $75 billion worth of spending in 2024. Will account for about $75 billion worth of spending in 2024 and be up combined about 12% year over year. If you look at all of the other 29 categories, what we see happening there is that spending in those markets will be up about 6%. So the aggregate is clearly linked to a much stronger market happening both offshore, where activity is up and pricing is up sharply, and the international market, where we're seeing higher rig counts and well counts and some improvement in terms of pricing. So let's get into the specifics of the regions so folks can kind of see what's happening to the markets that they care so much about. Left-hand side is our look at active rig count. Once again, looking at year-by-year numbers. So last year, rig count in the U.S., according to the folks at Baker Hughes, averaged 688 rigs. We're forecasting now that we'll see 628 active rigs here in the U.S. come 2024. We had been thinking, that's a revision, we've lowered our estimate for the 2024 numbers by about a total of 20 rigs, so that was about a 4% reduction, I guess. And that has been largely a function of these lower natural gas prices coming in and really hamstringing activity in gas-centric markets. So on a year-over-year basis, rig count we think will be down about 9%, from 688 rigs to 628 rigs. But if you look at it from an exit-to-exit basis, from Q4 of 2023 to Q4 of 2024, then in aggregate we think rig count will be up about 2% over that time frame. So a bit of an improvement as time goes by. But it's really telling if you disaggregate our numbers by the type of well that these rigs are drilling. So at the moment, or we're anticipating that rig count in the U.S., for example, will grow, oil rig count will grow from about 500 rigs in the fourth quarter of last year to an average of 520 rigs in the fourth quarter of 2024. So an improvement of about 4% in the oil rig count over the course of 2024. On the other hand, gas rigs we think will fall about 5% over the course of 2024. So we'll go from 120 or so active rigs in the fourth quarter of last year to somewhere close to 110 or 112 active rigs in the fourth quarter of this year. So again, just speaks to the weakness of gas prices and the relative strength, anyway, of oil prices as we think happening in the marketplace. So, supply chain problems have clearly eased. There's not that worry with regard to pricing or with regard to the cost of goods and services that drove the market back in 2021 and 2022. The only real issue when we talk to our channel checks right now is worries about labor availability. And I think that's one of the reasons why, until recently, we really hadn't seen a headcount among the oil service sector decline. So even as rig count fell on the order of about 20% over the course of last year, headcount among the service side really stayed pretty steady. And although it's begun to come down a little bit recently, I think the slow to pull the trigger in terms of right-sizing the workforce, just because of the issue of will you get them back if activity were to recover, and so where are you going to find your workers? And so hanging on to people has been a priority, more so than normal perhaps, in this cycle anyway. The other thing too is that we track, recognizing that we talk about activity, but we really have to think of the drilling side of things separate from, or in a way divorced from, completion-related work, since those are separate actions in time and can be separate investment decisions. Especially if operators in the course of this year are trying to save some money, gas producers are trying to save some money, lower their capital spending, so they drill the well, but they don't choose to complete and frack the well until some other time when prices are a little bit better, say. So that's, I think, something to keep in mind, and one of the reasons why we have separate numbers for rig count and well spuds and frack jobs and completions. Frack job count, we think, will be down about 7% in 2024 and then recover about 4% next year. So frack activity down about 7% this year, rig count down about 9% this year. And the reason that frack jobs don't decline quite as much as rig count is that we think there'll be a slight drawdown in the number of drilled but uncompleted wells out in the inventory. So most of this will probably happen in the oil-prone provinces out in the Permian and such. More so than the gas-centric areas. So it wouldn't be a surprise to me that we might see the drilled but uncompleted count of wells rise in the Marcellus and in the Haynesville, while at the same time it's falling out in the Permian and some of the other oily markets. But again, a bit of an improvement then as we get into 2025 and pricing for both oil and gas begins to recover. By the way, this is just a job count. So recognizing that frack jobs, the size of the job is impacted by the length of the lateral, which we clearly see is growing, and the spacing between stages, which has been shrinking. So the consumption per frack job in terms of water or sand or any other consumables has been rising pretty sharply. And so instead, if we measured frack activity in terms of some of those consumables, it would probably look pretty flat from 2023 to 2024, even if the number of jobs being done declined a little bit. So Canada, we think, is an interesting story. Activity didn't change very much last year, averaged around 177 rigs. This year, we think it'll average around 176 rigs, so virtually unchanged. And the reason why it looks so steady to us is that while natural gas prices are lower, and that might be expected to push activity or leave activity kind of soft, they're getting, and they've had built some new pipeline takeaway capacity, both on the oil side and on the gas side, is coming on stream. And I think that's going to help support the level of activity as operators prepare for increased exports, both on the LNG side, like we saw on a previous slide, and what looks like it'll be taking place on the oil side as well. So Canadian oil production is set to rise about 8% this year, just because, or largely because, pipeline takeaway capacity is in place to handle higher volumes. And so that, I think, will help support activity. At least that's how we read the tea leaves right now. Up in Canada, 176 active rigs, about 6,200 wells drilled in 2024. The other thing that, again, I think we need to keep in mind is what's happening in terms of where the natural gas production anyway is taking place, or where it's happening up in Canada. So it's informative, I think, to separate Canadian gas production between the output from the Montney Shale, which is the red line on your chart, and then everything else, which is the blue line. And of course, you can see the Montney has been growing since 2020, and while the other blue line has been basically flat to trending lower over the same time frame. And those two trends we think will continue through the end of the forecast period in this report, which is 2028. But in fact, we run the numbers even out to 2030. And by the end of the decade, Montney production we think will be somewhere approaching 13 BCF a day. So it'll be vast, a majority of gas produced from Canada will be coming from the Montney Shale. So that's a fact of life. The pipelines that are getting built, the gas takeaway capacity is taking gas and liquids to some degree from the Montney Shale to end markets. And so the pipelines are telling us where the production is going to come from, and it's all pointed toward the Montney Shale at this point. If you recently saw the recent story that Canadian Association of Petroleum Producers just came out with its own estimate that capital spending in Canada this year will total somewhere around $30 billion US dollars. And that's up from about $29 billion US dollars last year. So the capital spending side of things in Canada, according to the CAPP, is poised to grow slightly, about 3% year over year, which kind of fits what we think will be a fairly static market on the drilling side, but growth's happening on the production side as well. Finally, we want to take a look at the international market because that covers everything outside of North America. We start South America for us begins with the Rio Grande and goes south from there. So we include friends from Mexico in the South American numbers, but all that comprises the international part of the forecast. Like I said, last year it grew around 11% in aggregate. As you can kind of tell from the chart on the left-hand side, averaged right at 900 active rigs internationally in 2023. We think it'll grow to around 950 average rigs in 2024, so up on the order of about 6% in aggregate. And the chart on the right offers a breakdown in terms of the various growth rates by region. So last year saw the regional growth winner was Europe, which has offset the loss that it had seen the year before. And that's all really about the number of rigs working in the Ukraine, which has come back pretty strong over the course of the past year. All markets we think will grow come 2024 and 2025. The growth rates we think will range somewhere between 2 and 3% on the low side and maybe 10% on the high side. If once again, we think we've got the story right with regard to announced exploration plans and the final investment decisions being taken in terms of new field development work and so forth. Both things we try and track to give us some sense of action taking place in individual countries. So our detailed report, which and the Excel tables, which we send out along with this slide deck, contain information on a country-by-country basis, quarter by quarter and year by year. So we've got a lot of detail there for folks who want to follow along. But one of the constraints that certainly is coming to bear in the international market is in the offshore sector. So we're looking at among especially the most recent generation of floaters, semis, and drill ships, and the modern jackups anyway, near full utilization for both of those items. I think we got an 80% utilization on the floater side and like 95% utilization on the jackup side. And so there's kind of limitations on the upside as to how much more activity we might squeeze out of the offshore sector come 2024 and 2025. And that's really what I think the takeaway from this particular slide. So on the left is what our count we think in the international sector will be with regard to onshore land rig count. So up about 5% in 2024, averaging right around 750 active rigs and around 7,500 wells drilled. The offshore side is its own story there, with 199 active rigs for the full year, up 7% there, and 2,400 or so wells drilled. So, and again, if the folks who run the offshore contract drillers in the marketplace talk about how they think over the next 24 months that there might be another 15, 16 floaters enter the marketplace, and another 20 or maybe 25 jackups enter the market. Not so much new builds, because the new build story doesn't happen that fast. But those are the kind of numbers. Collectively, somewhere approaching 40 rigs on the offshore side might enter the fleet, or might enter the active market, in basically meaning they've scored contracts and they're earning money for their owner. That's not to say that they're actively drilling to the right, and that's part of the disconnect that we get asked about a lot, which is, why do we see reports of more offshore rigs than you have in your count, John? And that's because, again, according to the way we're counting an active rig in our numbers, it has to be drilling for at least half the time, actively drilling. Whereas, and for a well that's consuming oil and gas products, whereas other sources that count offshore rigs, or land rigs for that matter, often just count a rig as active if it's under contract. It need not necessarily be drilling; it might be working over a well. So it's engaged in a different way, and perhaps for a different purpose. And so the counts just differ because of the distinction in the definitions that different sources use. So finally, then, we want to talk a little bit about our specific regional forecast. We'll start with Central and South America, which we think will be up on the order of about 2% this year. We've scaled some of our numbers back in this particular market because the year just hasn't started off as strongly as we thought it might. But still, we think it'll be up for the year as a whole. Some interesting things going on. Colombia, as you can see there, has seen three different operator groups, Petrobras, Shell, and Ecopetrol, each have come up with offshore gas discoveries over the course of the past year or so, and a couple of them are being close to the point where they're certainly under plans for development, and they might get approved before the end of this year. Guyana, of course, has been a story now for quite some time, as ExxonMobil has now sanctioned 5 field development projects, 3 of which are in operation and collectively producing on the order of 600,000 barrels a day. So 5 projects that have been sanctioned. There are 3 others that are in the queue to be sanctioned, and we think they'll probably happen sort of 1 per year or 1 every 18 months for the next 3 or 4 years. And so at the moment, anyway, it looks like Guyana, which is producing, like I said, 600,000 barrels a day right now, will be in excess of 1 million barrels a day of production before we get to the end of the decade. So quite the story there. Its neighbor, Suriname, has also had a couple of different user groups, Total Energies and APA together have a project on Block 58, and they're looking to approve that one perhaps by the end of this year. And there's work on neighboring Block 52, which has also had some discoveries. So I think we'll have a second offshore province on the northern coast of South America emerge in short order there. And finally, Mexico, as we've said, has plans to increase and jump in the LNG export game, largely supplied by pipelines from the U.S. A lot of the about 55% of Mexico's gas production is in its northern part of the country. So it's, but it's not being aggressively developed. So to the extent that the gas to be supplied for LNG export is going to come from someplace, is going to come from the U.S., which even with transport fees is a lower cost development than is the case in some of these northern Mexican shale fields that are on hand. Europe, we think, will be up about 4% this year. So part of that is due to work in Norway. So Equinor has a pretty solid field development program in hand. I think there are 21 field development projects that are in various parts of the execution phase, and another 30 unsanctioned projects which are poised to follow. So just in Norway alone, Equinor looks to be pretty busy for the next several years. Most of these projects are fairly small in that they're tiebacks, subsea tiebacks to existing facilities. So they're not really lifting the oil or gas production capacity of the country. They're just sustaining output with these tieback projects that Equinor is pursuing. Africa, we think, as a region, will be up about 10% this year. Has grown fairly steadily for the last couple of years. Certainly, the recovery in global oil consumption, strengthening oil prices, has really helped the exploration work that is typically the biggest part of what we see happening in Africa as a whole, and that continues to be the case over the near term. So Egypt has big plans for billions of dollars to be invested in its E&P sector through the end of the decade. Namibia is the other exciting play that everyone is ginned up about. I think Total is talking about Namibia alone accounting for something like 30% of the exploration dollars that it intends to spend this year. So clearly a lot of work to be done to prove up development concepts, but both Total and Shell have projects that it is looking at to pursue in Namibia here over the next 2 to 3 years. So I'm sure we'll expect to hear approvals for each of those in short order. Slightly different stories happening in Nigeria, where we have 3 of the big majors, Shell, Equinor, and Eni, all exiting their onshore operations. So they're all still active offshore, but they are selling their onshore operations to indigenous companies. So the actions will presumably continue, but now be directed by other firms as these bigger outfits sort of rationalize their portfolio, either exiting high-cost areas or in some cases exiting high CO2 emission projects or greenhouse gas emission projects that they no longer want to be associated with. And then finally, the area that got all of our questions over the last 2-3 weeks has been what's the story up in the Middle East, and in particular Saudi Arabia, right? So the region as a whole, we think, will be up about 8% this year. Saudi Arabia, we still think, will be up for the year as a whole, but clearly it captured a lot of headlines when it announced plans that it would no longer expand its productive capacity to 13 million barrels a day, but instead hold it at its current level, 12 million barrels a day. And what that meant was that a couple of the big offshore projects that had been on the books, Safaniya and Manifa, have been canceled. Now, a couple of others that you see there, Berri, Marjan, and Zuluf, are all offshore. They're still going forward, it appears. The $100 billion Jafurah onshore gas field development is still on track. So it's not that the whole thing became a train wreck, but they've done some selective trimming on the Saudi Arabian side. Saudi spent around $50 billion last year in terms of CapEx. Saudi Aramco spent $50 billion or thereabouts last year. The thought is that with these cancellations that spend figure might drop by about 10%. So there's still a lot of spend planning to go on. And the reason for that is that even like any operator now, even Saudi needs to spend a lot on the brownfield side just to maintain oil production capacity. So it will continue with a pretty active program. We think there just won't be any output export capacity associated with the work that they're now going to do. UAE is a little bit of a different story. That was the question everybody else had. What about the UAE, Abu Dhabi, and Qatar? And each of their pretty aggressive plans for development looks to be in place. So ADNOC to spend about $150 billion CapEx, as it increases its oil production capacity to around 5 million barrels a day. Qatar, like I said, it's all about their gas and LNG expansion plans around the North Field. As a part of that project, there need to be built 100 new LNG carriers to take that liquefied gas to customers. Each LNG carrier these days goes for a cool $250 million. So just on the carrier side, there has to be spent on the order of $25 billion just to transport LNG to marketplace. So the dollars being spent to actually drill the wells are just a fraction of the total that Qatar has on plans to get its work done. But at the same time of its big gas field expansion projects, it's also trying to sustain its oil production capacity, which runs around 500,000 barrels a day, maybe 600,000 barrels a day. And so it's got a couple of big projects there around Ruya and Bulanin to maintain output there. So some billion-dollar projects, much smaller, but still billion-dollar projects in Qatar just on the oil production side. So in aggregate, Mideast up, we think about 8% this year. Asia Pacific as an area up about 4%. India has got plans to double its oil and gas production by 2040. Indonesia's got plans to increase its oil and gas production capacity by 2030. And so all of those things are tending to push the national state-owned companies to a more aggressive CapEx plan in terms of new field development and whatnot. And so that's, we think, is a big part of the story in a couple of those countries there. And Malaysia, too, is also got some interesting gas field development work going on that is, that will attract notice for largely. And then finally, we have China, which we offer numbers for China and Russia and Central Asia. Each of those three areas is pretty opaque in terms of getting numbers out on a timely basis and accurate numbers. But we think China will be up about 4% this year. And I'm sorry, those numbers for China are not right. China's going to drill around 24,000 wells in 2024, if we're correct there. What's interesting is CNOOC. So that's clearly the area where most Western oilfield service firms are going to be participating, and China Offshore has got some pretty aggressive plans to increase its output from the offshore sector and Bohai Bay in particular. I think offshore China produced around 1.2 million barrels a day. Bohai Bay is about half of that, and it looks to grow pretty significantly over the next couple of years. So we have a pretty good indication of activity going on there. But I think one of the bigger takeaways I have, anyway, near term, is that we have here in the U.S. Limited expectations for growth in oil production as operators focus on profitability over pricing. We now have the number 2 largest producer, maybe number 3, Aramco, scaling back its efforts to increase output and instead holding steady at its 12 million barrels a day export capacity number. And then Russia, the number 2 or number 3 oil producer, basically holding output steady. It's interesting, Russia increased its drilling activity on the order of 6 or 7% last year, and yet all it could do was basically sustain output. So it's needing to work harder just to maintain output from its brownfields up there. So you have the 3 largest producing countries, which collectively account for about 40% of the liquids produced on the globe, and each of them is basically seeing very little capacity growth in terms of its ability to increase production. So to the extent that demand continues to grow 1 million barrels a day-ish for the next several years, increasingly that's going to have to be supplied from areas that are kind of outside the big 3 markets of US, Russia, and China. And so something to keep an eye on as we think about where the opportunities lie for the oilfield service sector this year and next and over the balance of this decade. So with that, we'll go to some questions, which I know we've had a few come in. Let me take as many as I can over the next few minutes before we run out of time here. I think about 5 or 6 minutes. One of the question is, what about the pace of mergers and acquisitions? So we've got M&A work, of course, has been outstanding on the oil and gas producing sector over the last 18 months. I think we counted 31 or 32 projects, which collectively accounted for $200 billion worth of M&A over that. Most of it centered around the Permian Basin, but of course, if something happened everywhere. And that's a bit of a detriment to activity here in the U.S. this year, because as organizations merge and rationalize and so forth, that tends to slow the pace of work out in the field until things get settled. So, that I think contributes yet another non-quantifiable factor to some of the slowdown in activity. But I wouldn't be at all surprised that we continue to see M&A work continue on the producer community side of things. I suspect most of those deals will go through. I don't think that the concentration is such that the Department of Justice or any of the regulatory review would throw up a flag there. There may be some divestitures that take place afterwards if certain properties don't fit or whatnot, but I think the deals themselves would go through. Maybe a different story if we ever see the pickup in terms of M&A work among the service sector. Because the issue there is that you have certainly the bigger players in each sector have market shares that are 20% or higher in many cases, and so any combination of firms of that market share size, I think, would probably get flagged by the feds in Washington and may not let it go through, because I think they have their Herfindahl index calculation, which would say there's too much concentration. And so, there may be M&A activity that takes place on the service side, but I think it'll be smaller companies for the most part involved in deals. At least that would seem to be the case as where things sit right now. What's the possibility that offshore could be higher or lower than forecast? Well, like I said, I think there's kind of a cap to the upside because of the number of rigs that might come available to go to work. The downside case is, of course, always possible if oil prices disappoint. But again, I think the way the market is setting up with the big three not expanding capacity, that it's not the oil prices wouldn't disappoint because there's too much supply out there. I think it's, or people overproducing. I think it's a case of, is there something that might happen on the macroeconomic side that would cause economic activity to come in lower than what it was forecast to be? And a point I would remind us all of is that at the start of 2023, every economist that I believe the publication Barron's surveyed was calling for a slowdown in the U.S. economy in 2023, and none of them were right. We saw expansion throughout the year, and so current questions about how long will we have a soft landing, how fast the U.S. economy might grow, and so forth is there's perhaps more uncertainty about that than any other element right now, and I certainly wouldn't assign at this point high likelihood that there'll be an extreme disappointment in terms of the macroeconomic story that might cause oil prices to fall accordingly, especially if OPEC Plus remains positioned to try and defend prices by taking oil off the market, which I think is the case, would be the case there. Pricing discipline on the service sector has been pretty good. I'll just treat that at a very high level. And we think it'll continue that pricing, even though activity is run, much lower today than what it was 18 months ago. We really haven't seen much price softness on the drilling or the frac sector. So clearly, pipe was down sharply last year. Might recover, might not recover as the course of this year goes forward. But I just think that in the old days attitude, which was from among service firms to chase market share, try and defend market share by lowering prices in order to keep their crews and rigs busy. I just don't think that is what is being followed now, particularly on the part of the larger service firms. I think they're much more intent to try and protect margins and adjust their organization size-wise as needed. So we don't see a lot of pricing movement in terms of the cost of getting well drilled or completed. Maritime transport is not much of an issue in terms of field development work. The problems in terms of transiting the Red Sea, the Suez Canal, and then the Panama Canal, those two areas have caused problems, certainly. Red Sea is an interesting case because I think it's supporting oil prices in that it takes longer to sail around Africa than to get to Europe through the Suez Canal. And until we sort of get the tanker flows sort of repositioned, what's happened in the meantime is that some of the crude inventories and product inventories on the ground in Europe have been drawn down to make up for the fact that the ships weren't arriving as on a timely basis as they used to. So that's had a little bit of an impact in terms of pricing for commodities, as best we can tell. But in terms of the structures that get moved around, get built, and for field development, I don't think either the Panama Canal or the Red Sea has had much of an issue there, or will have much of an issue going forward. Panama Canal is, of course, a function of the ships can't go through, not as many, not as quickly, because of the lack of rainfall and the lower capacity of the lakes that keep the canal supplied. While that hasn't had much of an impact in terms of U.S. LNG exports, 70% of our exports go to LNG exports go to Europe. About half of our natural gas liquids exports go to the Asia Pacific market. So problems getting through the Panama Canal cause a real problem when you're trying to export shiploads of propane and butane and things like that. So this had a knock-on effect, and accordingly in terms of pricing for those products. And so a bit of an impairment with regard to the product, the price of the product at the wellhead. So, but that's about as much as we can tell right now with regard to the impact that the maritime issues had on the upstream sector. And with that, I'm about out of time. If you have any other questions that we haven't gotten to, please feel free to email me directly. I'll be happy to answer what I can at jrspears@spearsresearch.com. We, of course, continue to follow this market every day, and we'll be adjusting our forecasts if things come up that we think call for amendments. If you have any questions at any point between now and our next session and the first Friday in June, please feel free to drop me a line, give me a call, and we'll happy to discuss and try and answer whatever comes to mind. So until then, look forward to seeing you, and I certainly appreciate all your support. Thank you.